Good afternoon, everyone. Happy New Year and welcome to this quarterly review. It's quite a lot that happened in 2025, and I know that a lot of us were wishing the year to be over given everything that happened. But of course, things started with a bang, so there's lots to go through. Um, and as always, we'll do this in a sequence of looking at the market drivers. Um, that means, the macro environment, earnings, inflation, that kind of stuff. We'll look at performance and we'll wager an outlook by looking at a few charts that make you go, As always, there's a Q&A session. We'll get through the slides in about 30 minutes or so, and Hannah is standing by in case you want to ask questions. We'll get to all of those at the end of the webinar. Thank you very much for joining. We've got quite a few new listeners and participants, so you'll have to excuse my explanations of some of these slides, but it's all in good fun, and hopefully you'll enjoy the presentation. So as always, we start with a bit of perspective. This is a regression of the FTSE All World Index, kind of the global benchmark for equities. And equities, as you know, rule the world, so it doesn't hurt to look at how the global stock markets have done. It's heavily US weighted, as you know. It's about 55% US, less than the MSCI World, of course. So the rest of the world does have a bit of a space here. And as you can see, and like I said, this is just a regression across two standard deviations, and we're looking at this since 2009 because that's when quantitative easing started. And as you can see, we're well above sort of historical trends, which clearly bodes well for performance and makes for a lot of happy investors. And it's even looking a bit better than last time. The inflation picture has also improved a little bit. So what I've done here is I've looked at inflation versus our last webinar, last quarter. And as you can see from my little circles here, last time we were sort of at a 3% inflation rate. That's now dropped, which has also given rise to these rate cuts that we've had and expectations of more rate cuts going forward. So long may it continue. Back in the old days, back when I started about 30 years ago, we always looked at an inflation target of 2%. Nowadays, we're sort of looking at around 3%. That's considered normal by the Fed. Would have been unthinkable for the Fed to cut rates back in the old days at 3%. But nowadays, like I said, it's a new normal, given what happened in COVID and given all the stimulus that was put in there. So, like I said, looking good. Growth in the US is also looking good. These are the annualized quarterly GDP growth numbers here. And as you can see, except for that little dip that we had at the beginning of 2025, growth has been very good in the US. Sort of averaging around 4%. For Q4, the forecast is around 5.1%. Now remember, GDP is always a backward-looking indicator. That data comes out late, and economists are doing the forecast. And as you know, economic forecasts are something that needs to be taken with a grain of salt. But in any event, so far so good. And for Q4, we're expecting an annualized growth rate of 5%, which means that at the moment the U.S. economy is just brimming along at sort of the fastest expansion that we've seen in several years. What does that mean for rate cuts? So like I said, it's been priced in to go lower. So what I'm doing here is I'm looking at the implied rate cuts by looking at the forward yield curve. And again, we're looking at last quarter versus this quarter. And what I have circled here in red is the expectation for September last year. So back then we were expecting 4 rate cuts, which implied a terminal rate of 3%. Now we've had a rate cut. So this was back when the target rate was 4.25. So since then, in the last quarter, we had 2 rate cuts. So we're now at 3.75. So obviously we have less expectation of further rate cuts, but what you're seeing here in the implied rate is that we're just a bit higher than we were last quarter. So we've taken half a rate cut off the table in the US, and that is of course a function of growth looking good, but inflation is going down. So happy days. Let's see where we end up, but this would mean that we're going to get another 2 rate cuts by the end of next year. We are in the UK, so we always want to look at what's happening in the UK, and there the picture is slightly different, not necessarily from it certainly looks differently from an inflation and a growth standpoint. I'll get into that in a second. But also here, inflation has come off in the UK, which has given rise to rate cuts. So we've also, last quarter, we're running at 3.8. Now we're running at 3.2. I do apologize. These things have just sort of creeped over there. So that's nice. You always want to see this coming down. Whether or not the BOE is also looking at a 2% inflation target remains to be seen. That has obviously a lot to do with what Rachel Reeves does. But so far, happy days, and long may it continue. Now, this is where the UK differs a lot from the US, and whereas these bars look quite similar, the absolute numbers are quite a bit lower. So the UK hasn't been growing at all, or only slightly, so to speak. Last quarter we were barely positive. This quarter for Q4, we're pricing in, forecasting at least 30 basis points of growth. We just had the November figures come out, I think yesterday. So that bodes well. At least there is a bit of growth, but you can just see how differently the economies are performing in the UK versus the US. And that also means that the rate cut picture looks a bit different. So back in Q3, the target rate was at 4. We were expecting 1.5 rate cuts to give us a term rate of 3.6. And as you will notice, now that we've cut by 25 basis points, we are now implying another rate cut and a half. So that is a function of the growth rate just not being where it is. So the economy is being stimulated by these monetary policies. And yeah, the only thing that could sort of hamper these efforts is inflation. But as we saw in the previous chart, so far, so good. As long as this doesn't go any higher, these rate cuts should come through, should help the housing market, which needs it, particularly in London, where housing prices have really taken a large dip. But with all these increases in taxes, you do wonder where the growth is going to come from. And that's why this was such a pleasant surprise for everyone, and that we had a bit of growth in Q4. Apart from sort of this, battle between inflation and growth and rate cuts, the other main market driver are, of course, corporate earnings. And what you're seeing here are the expectations for this quarter. As it happens, we always have these webinars at the end of the quarter, which means the beginning of earnings season, which makes this all very, very exciting. And what we're seeing here is this world that we now live in, where you have the Magnificent Seven, these big tech behemoths that sort of live in the world of their own, and then the rest of the world. One is growing, one not so much. And so that's really what's been driving the indices higher, is this enormous growth that these tech behemoths have displayed. As you can see, we're now expecting 20% earnings growth for Q4 in the Max 7, but only 0.3% in the rest of the world, which is rather shocking, but that's the world we live in. On a consensus basis, going forward, you can also see that the Magnificent Seven, have had their earnings not revised down, whereas the rest of the S&P has had it revised down. But the one shimmer of hope is the expectations going forward. And as you can see in these green bars here, we are expecting the rest of the markets to now catch up a little bit. So hopefully staples, pharma, financials, industrials, that they grow a little bit. We'll get to it at the end of the webinar in a bit more detail, but there's a lot of fiscal stimulus happening right now as well. There are also some giveaways from the Trump administration, where people are being sent checks. Would be nice to get that over here in the UK as well, but we don't want to be jealous. But in that regard, that is accounting for this optimism in the US, is that all the stimulus will lead people to go out there and spend and propel the earnings higher. Geopolitical risks is the other main driver. So far the markets have largely ignored this, except yesterday when the idea was that Trump was going to start bombing Iran to help out the protests there. The S&P dipped. We had this. We were almost at 7,000, and then we dipped below 6,900. So the markets aren't necessarily happy about these strikes, whereas Venezuela was largely ignored, and seemingly no one cares about Ukraine. So this chart, by the way, was generated by ChatGPT. That's right. We're using AI. If we were a stock like Walmart and we're now, using AI, our valuations would go up quite a bit. That's a bit cynical, but that's the world we live in right now. And what I asked GPT to do is just give me a map of all the current conflicts. And the AI is so great that it not only gave me that, but it also gave us a rating of the severity. And as you can see, in red are the ones that are quite hot. Funny enough, Lebanon, Gaza, and Sudan are in red, and Ukraine is in purple, which is the most severe, and it's all sort of clustered around the Middle East, which is of course quite worrying. And now that Venezuela has been hit, ChatGPT also thinks there is quite a bit of risk going on at the Mexican border, which is quite shocking. But this map, the world is always in flux. The world is always in trouble. We've always had conflicts, but it certainly seems like right now there is quite a bit going on. The only thing that's more surprising is that the markets really haven't reacted to this at all. Even the oil price hasn't reacted much. Oil went from sort of 56 in crude to 61 just on these expectations of striking Iran. But again, going back so 20, 30 years back when I was starting to trade, any hint of any conflict in the Middle East would have sent the oil prices much higher. And right now the markets are largely ignoring it. Why is that? Who knows? Maybe it's just forward looking and people are expecting a peaceful resolution to these things, which might be a bit optimistic. But for the time being, financial markets have largely shrugged off these risks, but that doesn't mean they've gone away. So in summary, market drivers right now: inflation going down, that's good. Rate cuts are still being priced in, it's great. Growth is there, even the UK, fantastic. Earnings are also expected to increase. We haven't revised these down like in previous quarters. And geopolitical risks, as much as they're flaring up everywhere, haven't really affected us that much. So much for the macro environment. So what about performance? Now, again, what we're trying to do in these charts, and you'll have to forgive me, I like drawing things. What we're trying to give you here is perspective. So, you can look at charts in different time horizons, a short-term chart, medium-term chart, long-term chart. They look very different. And what we're trying to do here in terms of adding value to is alerting to where we believe the actions right now, which are the charts that are really driving things, which are the charts that the traders are looking at, and which are the ones where we could see potential changes. Now, I have a very skeptic quant that works for me, has been working for 10 years. Quants believe that everything is in the price. So she thinks I'm a bit of a dinosaur by drawing these things in here. But having said that, everybody likes to look at pictures and everybody likes looking at technical indicators. And that's because we just make sense of these historical price actions a bit better. And what you can see here, and what makes me think there's a lot to like about the S&P right now, is this trend line, the support line, that has driven us higher since April. Remember, in April last year we had tear of Liberation Day. Markets came off about 25%, which wasn't very nice. And since then we've just been on a tear. The S&P is up 40% since then. And this trend line hasn't been breached now, for the better part of 9 months, which is fantastic. And the other thing that I like is that we're now sort of at the top of this range that started in February, which was the previous high before Liberation Day. And also here, we've tried to break out to the upside in these resistance lines, and we might be poised again. So in that regard, I continue to like the S&P chart. There's nothing not to like, and long may it continue. The action, though, has been in Europe. So European markets have outperformed again. Last year, prior to Liberation Day, it was pretty succinct. The European markets were vastly outperforming the US markets. People were piling in, all on the political turmoil that started with Trump taking over the US administration. That reversed in the latter part of the year. So as much as Europe sort of powered ahead, for the first quarter, growth then sort of subsided. But now again, as a pattern that's quite similar to the quarter last year, we've had this outperformance. Euro Stoxx index, which is the one I look at here, this is the Euro Stoxx 50, which is kind of the small little brother to the S&P 500. It's the 50 biggest European stocks. It's a very liquid index, which is why we like looking at it. But before you get too carried away about European performance, remember that we just recently breached the high that we made in 1999. And for those of you who are wondering, how much the S&P's gone up in this timeline, the S&P's up about 200%. So Europe still has a lot to catch up on. It's a big breakout. Let's see what happens. But like I said, if you look at the macroeconomic environment, if you look at earnings growth, as much as people are nervous about what's happening in the US right now, it's difficult to like Europe. There's just no growth, no earnings, a lot of bureaucracy, a lot of stalemates. And so in that regard, this might very well reverse again. But for the time being, big breakout, happy days, long live Europe. Signs also of life in the UK. Here again, the perspective is going back to COVID. So remember those dark days when we're all locked inside, which seems like an eternity ago. But it did happen, and the market sort of dropped 35% at the time. And it took us quite a while to breach that in the UK. The US, like I said, powered ahead much sooner thanks to the big tech guys, which we just don't have over here. And the line in white is the FTSE 100. And the reason that that's gone or has performed a bit better than other markets, because 80% of FTSE 100 company earnings are from abroad. So it's not very UK centric, it's more international. And what you see in red is the FTSE 250, which are smaller companies in the UK, and their earnings are 50% driven from the UK. So it's a bit more UK centric, and you can see how much it's underperformed versus the much larger cap weighted index in the FTSE 100. But like I said, we've got signs of life here. I was beginning to give up hope in the middle of last year, but here we are, and we're finally powering ahead. And once we break through this support line, who knows, we might be off to the races. So signs of life, happy days, long may it continue, and let's see what happens. The emerging markets have also come good. You can see jumping around here, different time horizons. That's where we're trying to add value here. So what I'm looking at here now is the performance of the emerging markets index since 2021. That's when we last saw this high. Now remember, the emerging market index is heavily weighted to the Chinese market, which after COVID, initially the Chinese market outperformed massively because they didn't have the big outbreak. But then when they opened up, the Chinese market suffered quite a bit. It was down 40% versus these highs at one point, and that's why this index underperformed. But don't despair. We also have India, which is growing massively. Kind of never goes down. I always joke about the Indian markets. The economy is also growing at 7%, and then you have things like Taiwan and there and Korea. So all a lot of countries that you can get excited about. But again, it's taking us a while to sort of get back to where we were. So it's taking us a better part of 5 years now to reclaim the levels that we saw just after COVID. So I'm saying we're coming good, but we're certainly still way behind the US at this point. Switching asset classes now to the dollar. There's been a lot of talk about the dollar, weakening this year. Last year, particularly, the US dollar went down around 50%. By the way, in case you're wondering, this is the DXY index, which is the US dollar against a basket of the main currency. It's half the euro, which is the next largest trading pair, but it also includes the Japanese yen, includes the Noki, includes the pound as well. So this is an index that lets us look at the major currency pairs, and we've come down quite a bit, which if you're in the UK and you're investing in the US, it's not so nice because what you're making in US stocks and performance, you're then losing on the currency. But what I'm pointing out here is, as much as obviously it wasn't nice that we lost 10%, we have been going up. And again, looking at this since 2009, the trend is your friend, and the dollar has still strengthened. And historically, it's neither here nor there. So, whether or not the Trump administration wants to actively weaken the dollar so that they can narrow the trade deficit is a different discussion. But I am saying, it's not so bad. There's no need to panic. The dollar is still strong. It's still the reserve currency of the world. And until we see the euro strengthening for other reasons other than just people leaving the US markets, so far I wouldn't be worried about the dollar too much. Switching asset class again. So this is the bond markets now. So we're looking at US Treasury yields here. These are 2-year yields, and what we're seeing here is of course this massive rise in interest rates. Once we stimulated the heck out of the economy to come out of COVID, then we overstimulated. Probably we had this huge bouts of inflation. Inflation was running at 9% at one point, and that means that the Fed had to aggressively raise interest rates to slow the economy down. If you had given me odds on the Fed being able to engineer a soft landing back then, I said, about a 1% chance, but they've done it. So well done, Jay Powell, even though Trump now wants to get rid of him because he can't get these rates down soon enough. Trump wants to stimulate the economy. And in that regard, there's a bit of a battle going on. Obviously, we want the Fed to remain independent because once politicians start tweaking interest rates, they're going to do so to influence elections, which is why also these attacks on Powell aren't serving anyone. And hopefully Trump will have gotten the message from 11 other central bankers around the world who've all now stood behind Powell and said, we stand behind the independence of the Fed. If that goes, we'd be in big trouble. But it certainly looks like interest rates have peaked, not least of which because, Trump is in the position to nominate other Fed members. There's always a committee, the FOMC, they decide interest rates. The governor, of course, Jay Powell, has a lot of influence over this, but there is a committee, and Trump is sort of filling the seats now with his cronies. So in that regard, expectation of short-term yields coming down are there. We're just hoping it's going to be in an orderly manner. And Scott Bessent, who is a markets guy as the Treasury Secretary, will hopefully also have a bit of influence there. But it certainly looks like short-term rates have peaked. Long-term rates, not so much. So we're now switching here to Japanese rates and to Eurozone rates. And like I said, whereas you can manipulate short-term rates by just lowering or rising interest rates, the long end of the curve is a bit more difficult because that's driven by the markets. So in order to manage these interest rates, you'd actually have to go out there and actually buy bonds, which is of course what QE is all about. The government bought these bonds in order to drive interest rates lower. But that is not working at the moment. So these Eurozone rates now, which is on the right here, these are the Euro rates. They're now at the highest level in 5 years, which is a bit shocking. In Japan, I think those are at the highest rates in more than a decade. And don't forget, Japan has a lot of debt. They're running a debt to GDP ratio of around 275%, which means on an annual economy of 8 trillion, that's a lot of debt. And when these borrowing rates go up, it would really be a disaster. So this is one of the signs of the pending apocalypse, if you will. If this starts or if this creeps any higher, I'd be a bit worried. So far, it's not really causing any panic in the market, but watch the space. It's a sign that all is not well, and we need to be very cognizant of what that means. Which brings us to commodities and gold and silver, and what's going on there is unprecedented. I've never seen anything like it. For those of you who've been following me for a while, you know that I have this love-hate relationship with gold, and that's just because when I started my career, just gold did nothing. We always expected gold to go higher, it never did. Also in a crisis, it's usually gold goes down first before it goes up, so it's not really a safe haven in that regard either. But it's certainly paid for itself this time around. So we're up, I think, 120% in 12 months in gold. And people are buying gold now because people are worried about what's going on in the US. If Trump now starts to actively manipulate the markets, that means that there's less confidence in the US and particularly the US dollar as the reserve currency, and so they're buying gold. Central banks are also buying gold, particularly China, India, Russia, and there is this rumor amongst the gold bugs, as I call them, that we could be heading back to the gold standard. That remains to be seen, but it's certainly come a long way. And the only thing that's even more impressive than gold is silver. Now, again, silver isn't necessarily a precious metal because, whereas you can run for your lives with a bunch of gold coins, you're not going to do that with a ton of silver. But it certainly created a lot of fantasy amongst investors, mainly people who sort of thought gold is too high and they started piling the silver. There's also talk that it's a massive short squeeze because, of course, the banks are providing margins to these things, and they're on the other side of these things. And there's also a story out there that the US is considering silver to be a rare earth metal now. So all of this has driven silver higher. Myself, I thought it was all over at sort of 50. And that's because, when I was trading silver last a few years ago, you couldn't give it away at 16. Then we went to 50, which is the highest level we've ever had. So I thought it would come off. And I was right for about a month. And since then, it's just gone on a tear. So I've certainly stayed away from doing anything in silver. But like I said, I think this is pretty unsustainable. It'll come off. But then again, what do I know? I know even less about crypto. So, as we saw with Bitcoin last year, at the beginning of the year, Bitcoin went on this massive tear. So Bitcoin, by the way, is the line in white. So we went from, sort of the lows in January, sort of around 20,000. We went all the way to sort of 120,000. And the only thing that's surprising is that with the market's doing so well, that crypto hasn't. And so there's this decorrelation now that you're seeing. What I've done here is I've looked at the performance of the NASDAQ, that's the line in blue, versus the performance of Bitcoin and line in white. And you can see that we've had a massive underperformance in the last half year. Why? Maybe because people were too bullish. Maybe people have taken profits. Could also be that people have become skeptical or they prefer gold. I wouldn't discount Bitcoin altogether. There's a lot of institutional demand. Don't forget, we've only recently been able to buy Bitcoin and cryptocurrencies in these ETFs or ETPs here in Europe, which have spurred a lot of institutional demand. The FCA, the beacon of global regulation, has also now allowed retail investors to invest in these products. So there is a lot of underlying demand, but certainly it seems like a lot of people have taken profit. And right now it's just the air seems to be out a little bit. People are maybe a bit more worried than it seems, and that's reflected in these crypto markets. Right, so much for performance. So here's the crystal ball. What does it all mean, Chris? Where are we going to go? And whereas we don't know where it's going to go, we do look at a few signs. So most of that has to do with positioning. If people are positioned one way, then it tends to mean that they go the other way. And with the performance that we've had, it's not surprising that everybody is now sort of seemingly fully invested, particularly retail investors, which now make up more than 30% of US volume. So that's one that we can't discount anymore. So certainly people are still positioned very bullishly, not just retail, but also stock managers. They're also sort of near 100% exposure. Nobody wants to miss out on the equity performance. And so far so good. But obviously, as a contrarian index, if everybody is already in, where's the money going to come from to buy more? There's always, of course, leverage. Who knows? But for the time being, of course, everyone is long. They're also bullish. So expectations right now for global growth is at the highest level in 4 years. Go figure. Part of that is what we looked at in the macroeconomic charts that we showed early on. There's growth, there's earnings. So why wouldn't we be optimistic? So happy days. It's still all about AI. That's been driving everything. There's a lot of talk about AI being a bubble. Who knows? But for now, what I found interesting is that the adoption rate is slowing. So this I thought was a really interesting chart here. As much as I'm now using ChatGPT for this very presentation, I use it for my blog to sort of fact check things. It's a great tool, and particularly if you go for the professional versions, when the AI has a memory, it really learns a lot about you and can then really help you in a lot of things. It's also heavily being used in research, contracts. We had a contract that came in yesterday, and we want to compare that contract to the previous one we signed. So in the past, I would have given that to an analyst. They would have read through 100 pages and sort of taking notes, and the AI did it in 2 minutes. So in that regard, the productivity gains that we're getting from AI are amazing, but it is slowing now a bit. And the reason that's being cited is that, with if you give everything to the AI, you're not developing future managers, because ultimately the AI does what you tell it's going to do, just like you do to your employees. But somebody has to make these decisions, and if you're not learning the ropes, if you're not going through a process where you're learning or you're given these tasks to do, then 5-10 years later you just don't have any top management. And I think that's where companies are now they're wising up a little bit. They can't just not hire people and let all the menial tasks do by AI, because then you have this huge hole that's coming up as the current managers retire, and you just don't have any new talent coming in. So watch this space. Sadiq Khan just came out and said there's going to be a bloodbath in the city with AI. But look, we also thought that, with the advent of the DVD, nobody would go to the cinema anymore. And here we are, going to dinner now with every man. It's just the way things evolve. And I'm not one of these pessimists that think that, the AI is going to destroy everything that we know. People adapt. The human mind is incredible. Humans have adapted for centuries. And in that regard, like I said, it's a great productivity tool, but I wouldn't think it's the end of the world that we know it. What's interesting about the AI is the amount of money that's being spent right now. I think I had it on a previous webinar. The big tech companies they spent $400 billion last year on capex, mainly data centers and the like. And just to put this into perspective, if you look at sort of past major new technologies, we had the public works projects in the 1930s. We had the Manhattan Project, which was the atomic bomb. We had electricity. We had the moon landing. We had highways. Then we had the internet boom. And just look at how these capex numbers compare. Now, remember, these are not absolute numbers. These are relative numbers. So we're not, we're comparing apples to apples. But you can see as a percentage of GDP, this dwarfed everything. Fascinating, though, is that it's not debt driven. And this is, again, where this doesn't look like the internet bubble. I know people like to draw comparison to the internet bubble, to the AI bubble. And the internet bubble burst because we had this massive amount of debt that was taken on as companies had no earnings, and everything had to be made up by volume. But if you look at the cumulative debt issuance now to fund this, it's minimal. And that's partly because these tech companies are just generating massive amounts of cash, and that's then being refunneled into these infrastructure products. The U.S. economy, remember, we had these charts. People are leaving the U.S. because they're worried about everything that's going on, but the growth is there, and it's still the most dynamic economy in the world. And the reason I say that is because this tracks the number of business applications. And that means, startups. So these are entrepreneurs. So these are people who are actively trying to build things, which is sort of a hallmark of a thriving economy. And the US is still far beyond the most dynamic economy in the world. Europe is really being bogged down by this bureaucracy, all these things that you have to file, all these things that you have to do, all these national insurance premiums that you have to pay. There's really no help here to start new businesses. And the US is the exact opposite. And that is why, and don't forget, that's also where this tech boom came from in the US. These were all startups, Google, Yahoo, and all AOL, all these great startups in the 90s. They were made in the US because they had the infrastructure and the support of the government to start these companies, not so much in Europe. And if you're worried about the US, this would certainly make you feel a lot better. It's still very dynamic. People are still starting businesses, and very much innovation is driven there. Bank lending is also on the way up, so another positive. Bank lending obviously drives the economy because that's where people still go to borrow. Obviously, there's other sources of borrowing nowadays, including crowdfunding, but still the banks, they still control most of the money. And it's not just the US, it's also the Eurozone, which is a great sign for the economy, is that bank lending is up, because obviously banks would lend unless they were bullish, because they always look at the risk. So in that regard, that's another very positive sign. The credit recovery is also there, so more positive things. And you've seen these webinars where I'm very bearish and very doomy. So I've been accused of being too doom and gloom. So maybe this is the time when Uncle Chris gets a bit more optimistic. But what this covers here is the defaults. Credit recovery is all driven by whether or not companies can pay their debt. And as you can see, the distressed markets, have recovered quite a bit. So in that regard, we're nowhere near the levels that we saw just after COVID. So that's a good trend. We're still certainly not there yet. There's still a lot of distress in the global economy outside of the stock market. The real world isn't as great as it seems. Global growth is still sort of hovering at rates that were higher before COVID. But at least this is a good sign. This is a very good sign. There's also a lot of fiscal stimulus, not just monetary stimulus with these interest rate cuts. Governments are also spending. The Germans are investing in the military, which 80 years ago would have scared the heck out of people, but now being seen as a positive when Mercedes-Benz now builds tanks. So the Germans have invested hundreds of billions of euros now into the economy, mainly driven by defense, the US as well. So apart from monetary stimulus, there's also a lot of strong fiscal stimulus. So that, again, bodes very well for the global economy. This is a two-edged sword. So this is less optimistic. And despite all the stimulus, besides all this bank lending, despite all this credit recovery, the US job market is slowing. Now, before you get too upset about this is actually a good thing, because that allows the Fed to lower interest rates. So this is where the market sort of has its cake and it's eating it too. Pity, of course, the people who are out of jobs. Not so nice. But for investors, for capitalists like us, that's a good thing. So the unemployment rate going up, non-farm payrolls going down, whereas that may look like a negative, it's actually a positive, because that gives us these rate cuts that we need to keep market growth going. I know this is not so nice, but it is what it is. We're trying to make money here. This is not so good. So this measures the cash level. I was alluding towards that when I said, everybody's long, everybody's optimistic, so everybody's obviously bought in, and this is a reflection of that. Right now, there are very few, there's little cash around. So this measures, this chart here measures the amount of cash that fund managers have on their books. And right now, this is the lowest level in 26 years. Now, the reason that you have these little circles here, and they do correspond to not so nice times in the market, December 2008, just before the crash, October 22nd, that's also when markets were selling off, April 20, COVID, it's a contra indicator. When there's a lot of cash, that usually means that markets then go up, because at some point the fund managers get paid to put this to work. And at the moment, there is no cash. So unless, investors keep giving them money, they just don't have any ammo to buy more, which, isn't good. And then finally, sentiment, again, another contraindicator. When everyone's bullish, that tends to mean that we go down. When everyone's bearish, it tends to mean that we go up, just because, again, when the last bull has sold, markets go up. So at the moment, we're kind of in the middle of the Goldilocks scenario. We're kind of greedy, but not so much that it's extreme. And in case you're wondering, this is exactly the same level we were at last quarter. And finally, and this might be a chart that only interests me, this is the global investable asset universe. By the way, we're doing well on time. I'm running a little bit over. I want to get to your questions. And the reason I'm showing you this is because of gold. So this measures the total market cap of all the assets traded on exchanges. So this doesn't include private markets. These are just exchange traded assets, which is, of course, what we're looking at here as well. The big takeaway here is the US is still pretty dominant. US bonds and stock still make up almost half the global economy, which is also why people tend to still be invested in US no matter what Trump does. But gold, now after the surge, represents almost 6% of the global investable universe. What that means for your asset allocation, that's up to you. But I just thought that was interesting. Cool. That brings us to our poll. Remember, after this great wall of knowledge, I always give you a chance to then prove your mettle, and that means we ask you questions in terms of how things go. So the first thing we want to do is a house cleaning. and figured out how we did last time. So we always ask you, is the S&P going to go up or down over the next quarter? And from what I recall, most of us thought we would go up. 69% of us thought the S&P would go up, and we were correct. Probably a lot less so than people thought. We had a bit of a Santa rally, but we also had a few dips there as people got worried about AI evaluations and the likes. But still, a win is a win is a win is a win. The other thing we asked you whether gold would go up and down. We're always very topical in these questions. We always, aside from the SP, try to pick things that is on everyone's mind. And remember, also last quarter already, gold had this massive run. So is gold going to go up or down? We asked you that last time. 62% of us thought it will go up, and survey says it did go up, and a lot more than the S&P. Now, the next slide is one that I'd rather like to forget, and I shall never ask questions about sports again, but I asked you whether Liverpool will be at the top of the table. And as you might recall, last quarter, Liverpool started the season well. We won 7 in a row, mainly in the last minutes. So I was quite optimistic as a closet Liverpool fan. And I asked you, will Liverpool be at the top of the table? And you said, no. Now, as it happens, a lot of my friends are Arsenal fans. So it wasn't only that people said no, but they also said Arsenal would be on top. And gosh, they were right. And I shall never ask this question again. I shall hide my head in shame. Right, this time now. This is now your chance to vote. Can you please let us know whether you think over the next quarter, and that means, sometime in April when we have the next webinar, we will know, will the S&P go up or down? And Hannah is now nice enough to give you a chance to vote. Ooh, I can actually see this, Hannah. Yeah, the app has changed, this webinar app we're using, and 71% of us think it's going to go up. Fantastic. Great. I like that. 73. Great. Next question. Is silver going to go up or down? Now this, remember, it's gone parabolic. We are almost 80% above the all-time high. Oh, this is looking a bit more differently. 69% of us think it's going to go down. Yeah, I think it's going to go down, but that might be a contra indicator. Thank you so much for the votes. And that brings us to questions. Before I do that, just a reminder to stay in touch with us. We love to hear from you. We have our weekly blog where we pick up the big story from the week before. We put 250 short cynical worlds around it. We have a monthly newsletter, and of course we have the quarterly webinar. And anything and everything you'd ever wanted to ask, please do so. Get in touch with us. We like I said, we want to hear from you. Right, that brings us to questions. Hannah, what have the smart members of our audience wanted to ask?
Okay, first question. How long can the market ignore geopolitical risks?
It'll go until it won't. What was interesting was this reaction to the market when the Trump threatened to bomb Iran. We didn't have that with Venezuela. No one cared about Venezuela, which is ironic. But Iran, people were a bit more worried there. And I think we've now reached a point where Trump has just pushed the envelope as much as he can. The Economist just ran an article saying that Trump's in a hurry. That might be the case because we have the midterms coming up, or because he knows that he's on the wane. Even RFK Jr., the health minister, said he doesn't know how he's still alive. So there's this flurry of activity going on right now with Trump. The cynic in me also says that he's doing that to hide away from the Epstein queries, which no one's talking about anymore. But I think he's now reaching his limit. And if he just pushes this a bit further, the markets could react very severely. And Iran is obviously a very different kettle of fish to Venezuela or Gaza. Not so much Ukraine, but then again, we just have this war fatigue now. So I think we've reached our limit now. I don't think he can go any further, which doesn't mean he won't. But I'd watch these headlines.
Okay, second question. What is the outlook for gold and Bitcoin?
Gold and Bitcoin, and I like the fact that we've lumped these together because one's the digital gold, one's the physical gold. Obviously we've had a bit of a dichotomy in the performance. I think there's a place for both in every portfolio, for the reason that I mentioned. They're both liquid, they're both traded on exchanges, and they are just a bit different to everything else. I think the danger in gold is that the unthinkable happens and the world normalizes. Yeah, I know. It doesn't seem very realistic right now to think that there could be peace on Earth, or that Trump will slow down, or that he's being forced to slow down. But if there's any hint that this is peak Trump, I think gold will fall like a rock, because there's just no reason to then speculate on it. And mind you, a lot of the buying in gold is speculative. And we know that because of the margin. The margins on gold are at a record high. So people aren't buying gold physically, they're borrowing to buy it. And when that drops, these are the first guys that then, sell out of it. Having said that, if the world continues to do what it does, you could see gold at 10,000. Which makes this so interesting. What we do here, is another here. But just don't put all your money in gold, is what I'm saying. Don't get FOMO now. Is that you have to pile in because it's gone so high. Markets are a two-way street, and before you know it, things can also then normalize. Bitcoin, slightly different story, because people are buying Bitcoin for different reasons that they're buying gold. But like I said, there's a lot of underlying demand in Bitcoin now. It has a market cap of roughly 2.5 trillion. So, it ain't going to go away. And the adoption is increasing. I have one client who keeps telling me that, we're in a deflationary world and Bitcoin is the only hedge against that. So there are a lot of Bitcoin bugs out there, just like there are gold bugs out there. People who are really into this and have put, quite a large part of their wealth into the digital gold, so to speak. So and the other thing I like about Bitcoin is that, I know it's off the highs. It was at 125. Then it went to 80,000. But it's not down as much as the altcoins, which of course have plummeted down as much as 50%. So I'm more optimistic on Bitcoin than I am on the rest of the cryptocurrencies. I do think it has a place in most portfolios, and I think it's here to stay. So in that regard, I think Bitcoin has just as much a chance of having a great year as the Nasdaq. And like I said, I think it belongs in every portfolio. Hopefully that answered the question. A lot of ramblings there, but hopefully I made a point. Next,
Okay.
Hannah.
Next question. Is the fact that the global liquidity index M2 is still close to its highs a bullish indicator?
Yeah, I love this chart that Holger Zvetskic, he's an analyst in Germany. He keeps posting this chart, and what he's doing is he's regressing the M2 against the performance of the stock markets, and there's almost a 1-for-1 correlation. So as M2 expands, as liquidity expands, so do the markets. There's nothing that's stopping that right now. So there's still a lot of liquidity being added. As we saw, through monetary stimulus, and certainly the central banks are providing a lot of liquidity to the banks. That's also that's caused this bank lending to go up. So I think M2 will continue to expand, and that bodes well for the market. I don't see anything stopping this. So the fact that it's at a high right now, I don't think means much. I think it'll just go higher. I don't see M2 slowing down anytime soon, at least not this year.
Okay. Next question. Should investors make a tactical asset allocation into Europe away from the US?
I love this question. And if you are going to do this, then you're going to have to do it a lot of times. So what I mean by that is that, when you're doing a tactical asset allocation, you're trying to time the market. And, as I say on the trading floors, timing is a female dog. And, it's very difficult to do that. And chances are that you're going to get, as much wrong as you can make it right. So that means you have to do a lot of trades to make the numbers work for you. In other words, if you now allocate into Europe, when are you going to get out? How long are you going to do it? Do you have a stop loss? Do you have a time horizon? And what else are you doing? And for this particular reason, I also have a chart that I've prepared, and that is the danger of the tactical asset allocation. And by the way, I did not know this question is coming. I've had this chart as part of this presentations for years, and finally today somebody asked this question. And this is the danger of a tactical asset allocation. Now, if you get it wrong and you then miss out on the market going the other way, that destroys your performance. So what this chart tells you is that if you miss out on the 20 best days, so let's say that you make a tactical allocation, so you allocate into Europe, and then the US has the best days while you're doing it, over time, in the last 3 decades, that means that you're trading performance by 27%. And that is the danger. It's very easy to get out of the market. It's very difficult to get in, particularly, if you get out and then it goes the other way, you don't really want to cut your losses, right? You're going to wait, wait. And it's just natural. I've been there. I was a trader myself, and that's why you have to work with stop losses. So short answer, if you're going to make the tactical allocation for whatever reason, and I don't know the answer to that question, but if you're now convinced that Europe is a place to be, you got to know when to get out. If you're doing it for a longer time, fine. But if you're doing it as a trade, then you need a stop loss. And that means that if you're wrong, you're going to get back in. And similarly, if you're right, at what point do you take profits? And like I said, the danger is that you get it wrong. And unless you do hundreds of trades a year, this is a losing game. That's why we have hedge funds. And that's why, most of the wealth managers in the UK underperform the index, because they're all doing this and they're all getting it wrong because markets are random. And so the only way to beat them is to have a system. And the only way to implement that system is to do it lots and lots of times. In other words, to make money from timing, you have to trade. You can't invest. I'm so glad this chart came up, Hannah. I'm so happy. Great question you picked up. Wow. What else you got?
What do you see as the biggest risks for 2026?
Biggest risks for 2026? Well, apart from the US invading Greenland or kidnapping Starmer, these geopolitical events which are event-driven, I think economically the biggest risk is that we don't get inflation under control. Because remember, a lot of the performance, particularly in Q4, have been driven by these expectations that we're going to get more rate cuts. The rate cuts are like the elixir of the markets. It's liquidity, things are cheaper, it spurs speculation, people borrow, happy days. So if inflation goes up, on the other hand, then we can't cut the rates. And if we then take these expectations away, we're going to have a problem. And I think we saw that a couple of years ago. I think we went at one point, we were expecting 7 rate cuts. Then inflation went up, went to 0, and the market just dropped like a stone. And then luckily, the labor market deteriorated. I keep coming back to that. And we got these rate cuts back on the table. And rates have now, of course, come down from peak of 5.25 to 3.75 in the US. But that economically, for me, is the biggest risk, that inflation takes up. And, as someone who studied economics for 6 years, I kind of think it has to. I mean, these tariffs are, they're a tax. They're making things more expensive. And, all these trade agreements that are now being ripped up and being implemented, it's a bit like throwing sand into this global supply chain, right? So that can't be good. On the other hand, you've got these productivity gains of AI, which have kind of negated these tariffs. So that's what I see as the big battle this year is will inflation kind of draw a line under these rate cut expectations? So that's economics. I'm less worried about earnings, believe it or not, because these tech companies, no matter what happens, we're going to be on our phones. We're going to watch Netflix. It's hard to see this earnings growth in the tech companies slowing down, and because they're making up, such a large part of the stock market earnings growth. I'm less worried about that, and they're not overvalued either. If you look at the valuations of the Magnificent Seven versus the growth they're experiencing, they're not expensive. Look it up. Palantir is expensive. Palantir is trading at 1,000 times earning. Rheinmetall, SAP, they're expensive. Google and Nvidia ain't, believe it or not. And then the other risk I see is U.S. politics. I mean, we also have elections in Hungary this year. so there are other elections around the world which are quite pivotal. We also have local state elections in Germany now, which could move us to the far right. But yeah, the U.S. midterms, that's the one that I'm really worried about, because that would be one way to just slow Trump down. We're not political here. I'm not saying anything bad about Trump. Like I said, markets are up, so happy days. But I just like it to be a bit more ordered in what he does. I just like him to slow down a bit. And some of my Republican friends are saying the same thing. I don't mind what Trump's doing. I just wish he'd slow down. And that, of course, that could happen if the Democrats regain the House. If they don't, then I just see this continue now. This unhinged, flurry of activity will continue to be, and everyone's just getting a bit tired of that. So long answer, short point. It's inflation, it's geopolitics, and it's the U.S. elections. So that's what I see as a big risk for 2026.
Okay, last question. What are the signs that a crash is coming?
Signs that a crash is coming. Like I said, these long-term rates. I would look at that. Credit spreads. At the moment, credit spreads are pretty tight. You saw that chart I showed you. The default rates have come down. And what I mean by credit spreads, of course, is the difference between sort of the government versus corporate bonds. So right now, normally there's a big premium, particularly if you buy high yield bonds, those are higher interest rates than government bonds. So those credit spreads are pretty tight. And that's what I look for, if these widen. Apart from that, there's the usual candidates, the risk markets, the VIX, the MOVE index, which so far have been very sanguine. They're not implying any crash right now. What else I used to look at? Small caps, the Russell index in the US consists of 2,000 stocks that are, smaller, obviously, than the S&P 500 stocks. 40% of those right now have negative earnings. So if that increases, I'd get a bit worried. If bank lending decreases, these are all signs. In case you're wondering if it works, no. I've gone as far as looking at every crash sign in the world, building a model out of it. The problem with a crash is that every crash is different, which is why you can't predict them. And normally crashes happen when nobody expects them, which is why I don't think there's going to be a crash right now, because everyone's talking about a crash. But the minute everything's quiet and the minute everything looks too good, that may be when you should get worried. You heard it here first. Words of wisdom. Anything else, Hannah?
No, I think that's good.
That's good. Well, thank you very much for your attention. And like I said, we love to hear from you. If there's anything that we have covered that you'd like more information on, or if there are any questions we haven't asked, please do reach out to us. We'd love to hear from you, and do stay in touch. Looking forward to seeing you next quarter and seeing what happens then. All the best. Thank you very much for your attention.